All right. Hello, everyone. My name is Peter Kincaid. I'm the CEO of Raintree Capital and all its related companies. And I'm excited today to talk to you about optimizing your cash flow utilizing alternative investments. And we're going to give some consideration to how to use alternative investments to diversify your portfolio and some thoughts to think about if you're interested in doing so, as well as talking about a few of the tax effects as it relates to making some of these investments and how that might be better managed in your portfolio. So with that, I will get the presentation moving forward. Of course, many of the thoughts here are the opinions of myself personally or Raintree itself, and we strongly encourage you to speak to a private wealth advisor if you're looking for advice on these types of investments. So I just want to start by talking about a little bit about where we're at in the market today. And by market, in this case, I'm talking about the equity markets. And in particular, I'll focus in on the S&P 500. One of the metrics that we focus on here at Raintree is what is called the cyclically adjusted price to earnings ratio. It's often also called the Shiller PE ratio. And that's because of its founder. And what the Shiller PE ratio is it's effectively the combined value of the marketplace today as it's trading. So all of the stocks added up together, divided by the last 10 years average earnings. And so you may have heard of the price to earnings ratio. That's a pretty common ratio to look at. And basically what that means is how many times earnings are you paying for the market? And if we separate that out and just talk about a single stock, what that means is, let's say that stock makes $1 million of earnings and it trades at 25 times that. So its total capitalization is $25 million. So if you wanted to buy that company, all of its stock, effectively you would pay $25 million for that stock. Then you would earn that or get that earnings stream. So another thought exercise that might even simplify the thought even more, my colleague Adam uses the example of a hot dog stand. I'm sure many of you remember hot dog stands. And imagine there's a hot dog stand on the corner near you. They sold hot dogs and they made $100,000 a year selling hot dogs. You know, it's quite a busy hot dog stand. And you went to the owner and said, man, I think that your hot dogs are just the best. Could I buy your hot dog stand? And they turned around and said, well, sure, I'd sell it to you for $3 million. That sounds like a pretty steep price to pay. And that theoretically is the same sort of thing that we're talking about when it comes to the market. So we use the cyclically adjusted price to earnings ratio to sort of look at where markets are valued. And I think, importantly today, the markets are at a point that's actually higher on the same metric than right prior to the Great Depression and the 1929 stock market crash. And the only time it's been higher is the dot-com bubble. So, we're a bit concerned about how the markets are priced today. And at the same time, bond yields continue to go down. So these are the 10-year government bond yields here in Canada and the US. And recently, they've been trading below 1%. And to contextualize that for you, that means if you give the government your money and they're going to pay you interest on that money, you're actually going to earn negative, what are called real rates. So if you adjust for inflation, which typically runs between the 1% and 2% range, you're actually losing the value of your principal in that investment. So those are the market conditions that we're operating today. And maybe to further contextualize what impact that's had over the last 30 years, there's a company in the United States called Callum and Associates. They produce market research, and they looked back and they looked at what type of risk a portfolio would need to take to generate a 7.5% rate of return. And in 1989, you could have your portfolio basically be US fixed income and cash. And cash means effectively your bank savings rate. And your risk associated with that was reasonably low, 3.1%. And that's a volatility measure based on how much the value of that portfolio is going to go up and down over time. And what you can see is over the last 30 years, the required risk and the asset mix, so the types of investments that you would need to own to generate that rate of return, has changed and evolved substantially. Where in 2004, you could add equities to your portfolio and still have a fairly sizable amount of US fixed income. And now, just last year, when they updated this research, you would have to have a much more diversified portfolio, and you would have to include private equity and real estate as part of your asset holdings to generate that 7.5% return. And you'll see the volatility measure goes up to 18% standard deviation, which means, again, it's a measure of the risks that you're taking on in that portfolio. Now, you may not have a 7.5% return objective. Yours may be lower than that. They did do this for 5% returns, expected returns. And again, the evolution of the portfolio does require enhanced complexity and enhanced risk to generate the same type of return. So this does come down to your objectives as an investor. And you're going to see that thematically in my presentation today in terms of what is your objective in your portfolio. But oftentimes we talk about expected returns being those similar to the historical returns. And I think for the reasons that I just stated, the expected returns are probably not the same as they were historically, particularly in the bond market where interest rates can't go much lower. And as a result, if interest rates go up, you'll actually see the capital value of those bonds erode because that's what happens to the price of your bonds if interest rates go up. So we don't think that your expected returns or past performance is going to be indicative of future performance. And that's why I think Callum and Associates has come to the conclusion that you need to consider adding other types of investments into your portfolio if you want to generate the same return as you have historically for the same measure of risk. And so one of the explanations that I'm seeing in the news a lot lately is a term called TINA, and that is there is no alternative. And our view is that there is actually an alternative, and we're going to talk about why there's an alternative, what the alternative is, and what that reference is there's no alternative to holding stocks and bonds. And we do think there's an alternative to holding stocks and bonds, conventional stocks and bonds, and that is private or alternative investments. So let's talk about TINA or actually the alternative that we think is available to investors where this may make sense for. So first of all, I'm going to start with private and alternative investments. What are they? This is the CFA, Chartered Financial Analyst. I'm designated with that designation. This comes from the curriculum, and it's the explanation of what is an alternative investment. And this is the one slide that I'm actually going to read, just because I think there are some highlights in here. So alternative investments comprise groups of investments with risks and return characteristics that differ markedly from those traditional stocks and bond investments. Common features of alternative investments include the following: relative illiquidity, which tends to be associated with a return premium as compensation, diversifying potential relative to a portfolio of stocks and bonds, high due diligence costs for the following reasons. Investment structures and strategies may be complex. Evaluation may draw heavily on asset class, business specific or other expertise, and reporting often lacks transparency. Unusually difficult performance appraisal because of the complexity of establishing a valid benchmark. So, a couple of highlights here. One, return premium. So that means you should expect a higher return relative to other traditional securities in taking on a number of risks, illiquidity, high due diligence costs, and difficult performance appraisal, and a lack of transparency or reporting. And so that is the trade-off, and we'll talk more about that. But I think it's an important trade-off to understand. If you're looking to enhance the return of your portfolio and look to integrate private or alternative investments into your portfolio, you need to trade off the fact that there's a liquidity and lower transparency requirements and other risks per investment that should be given some consideration. But I think that, you know, one of the things that often investors lack a lot of thought on or sort of think a lot about is investing with a purpose and thinking about their objectives. Why am I making the investments in my portfolio? Why am I going to make this next investment? What is the objective that I'm trying to meet? And so that may be income needs, it may be target return requirements, it may be looking to manage the risk or downside in your portfolio, it may be expected inflation and you wanting to match that type of potential risk, or it may come down to tax planning and using certain investments to manage the tax planning around your investment portfolio. So some investments will meet these objectives, some won't, but it's really important to think about what objective am I trying to achieve? And we are going to talk about a couple of objectives today in terms of maybe some income needs or target return requirements. We're going to talk a little bit about expected inflation and tax planning as well. So real assets and inflation. Real assets is another word for buying things that are tangible. So probably the best example of that is real estate. It's a tangible asset. We can look and touch it. And one of the concerns that I think a lot of investors have today is whether we'll see inflation because of all the money printing governments around the world have done. And this study looked at how different types of investments were correlated, so acted alongside of inflation. And what they found was that real assets or real estate and other types of real assets, farmland being a good example, were more correlated to inflation. So if inflation went up, those assets, those types of investments went up more closely or in lockstep with them than other types of investments like large cap stocks or small cap stocks. So this is obviously one study. This relationship between those types of investments may not hold true in the future, but historically there's been that type of relationship. So if you're thinking about inflation these days as being a cause for concern, real assets may be part of your composition to try and combat or move in lockstep or more closely align yourself with inflationary pressures. The other trend that we've seen is significant growth in alternative investment allocations. So this is a calculation of the private markets up to the end of 2018. And I can assure you this trend has continued. You see a lot of growth, assets flowing to private and or alternative investments. And these are different types. You'll see private equity, real estate, private debt as being the primary categories of private investments. And so we've seen a tremendous amount of fund flows in the trillions of dollars to these types of investments. And so again, when you hear about TINA, there is an alternative, and we're seeing a lot of capital flow into the private markets globally. The other thing I'll highlight here is that sophisticated investors have also been allocating significantly to predominantly real estate and private equity. So here, I hope you can see my cursor. You'll see a large component of high net worth. And for everyone's benefit, Tiger 21 is a club, effectively. And to join the club, you have to have at least $10 million of net investable assets. So these are what would be termed as ultra wealthy investors. And they share their portfolios with each other and compare notes and talk to each other about different ideas. And then they publish those allocations publicly for the rest of us to benefit from. So you can see here that real estate's a large component, and private equity here in the darker blue, maybe royal blue. Those are large holdings within these portfolios. Now, you may not have the exact same time horizon, risk tolerance, financial capacity, or liquidity needs that these investors have. All we're trying to show is that there are larger and larger allocations going into these investments, and people are using these investments as part of their portfolio construction. So if you haven't started to use these, may be time to give some consideration, again, to that concept of TINA and whether there is a real alternative or not. One of the things we developed here over the last year or so was a framework to think about diversifying your cash flow. And I think many people are looking at how their financial lives are constructed, and they're thinking about, where are my sources of cash flow coming from? And we think that there is a bit of a methodology to work from in terms of thinking about the sources of your cash flow. So for many people who are actively employed, you have employment income or active business income that you're generating. And for many people, you have investments. So you have capital gains that, as the asset value grows, eventually the return on that investment goes up. And so you have some capital gains there. But we think there's some interesting thoughts to be had in the middle section. So interest, business income, dividend income, rental income, royalty income. Some of those forms of income can be generated by yourself personally. You can start a business. You can lend money to someone. You can buy a property and rent it out. You can do these things personally. If you're anything like me, though, you're probably pretty busy during the day. You may have a family at home or other activities that you're doing at night, and don't have a lot of time to actively look for those types of investment returns and create those fund flows directly. And so we think that alternatives can provide some diversifying to the cash flows that you're generating in your financial plan, in your portfolio. And so we're going to put some meat on the bone, so to speak, in terms of some ideas that may touch on some of these concepts and be a way to diversify your sources of income in your financial plan or investment portfolio. So we're going to just give some examples, and I want to make sure that you understand this isn't an investment recommendation. I'm not pitching you on any one of these ideas. I'm really just trying to contextualize, hey, this is maybe different than I've experienced before, might be unique, and I might want to do some more investigation in terms of how this might fit for me. So first example is an investment offering that we offer called New Look Capital Dental Fund. And I describe this as a unique source of interest income. What this fund does is it raises capital to then invest into dental practices. Now, we are all familiar with dentists. I think we're familiar with the fact that they make reasonably good livings. But for you and I, or at least myself personally, I'm not a doctor and certainly not a dentist. I'm not allowed to own a dental practice. You need to be a dentist to own a dental practice. So what this investment is it allows anybody to effectively invest in the cash flow stream of a dental practice by way of a loan, and then generate income on that investment. It's a 9% fixed income investment, subject to available distribution proceeds. And right now, the fund invests into a portfolio of 12 dental practices between Saskatchewan and Ontario. There's no publicly available dental company that you can go buy on a stock market. So when I describe this as unique, it truly is unique in the fact that there are no other alternatives to buy into a dental practice like this for Canadians. So it really is a different source of interest income, and we think could be a nice diversifier in one's portfolio. Another example is Lynx Equity Income Trust, and this is actually effectively a royalty fund. And what is a royalty? Well, a royalty is a contract to generate revenue from a stream of income. Royalties are often used in the mining and minerals or oil and gas business. Recently, there's been more news around music royalties. And what this investment is it's a royalty on the cash flow and revenue stream of privately held businesses in the United States. So Lynx is a private equity firm. That's what we would describe them as. And this investment funds into their US portfolio. And the returns have gone up based on the portfolio's revenue going up historically. So it's a royalty on that business's revenue. Again, unique source of cash flow. Now I'm going to finish off on just a couple of quick examples of more real estate oriented investments. This one's MakeSpace Capital Partners. They invest in self-storage businesses. They also have some mobile storage associated to their properties. And they generate a 6% distribution subject to availability. And that distribution would be treated as what's called a return of capital. And I'm gonna reiterate that concept in a slide or two here. Durham Industrial REIT owns a portfolio of industrial properties in Western Canada. Again, they pay a distribution of 6%. And again, that return, that cash flow, that distribution has been treated as a return of capital and should be treated as a return of capital. And why that's important is really for tax planning purposes. What a return of capital means is that real estate businesses, you amortize the value of the assets over time. And though those businesses are generating positive cash flow, for tax purposes, because they have that large amortization, or it's often called tax shield, when they pay that distribution out, it's treated as return of capital, so you don't pay any tax on it. And then in the future, if you sell that investment, and both these investments, the expectation is that they would generate a larger return, total return. So we expect the value of those assets to appreciate over time based on the work that they do and also the market. If that return does go up, what you pay is a capital gain in the future. So effectively half of your income rate in Canada currently. And that's really tax effective. And from a tax planning perspective, we think that makes a lot of sense, which I think does come up to another objective that many Canadians are probably thinking about today. I talked a little bit about inflation and some people being worried about inflation. I think another worry that many people have is taxes rising in the future, given the sheer amount of fiscal stimulus and money spent by government through this pandemic. If you expect that we need to repay that money at some point in the future, I think a potential likely outcome is taxes. And so From a tax planning perspective, the neat part about alternative investments and some of the private investments, and there are public investments that would have similar tax attributes, so it's not just private investments. But some of these would be characterized as return of capital. That can be really tax efficient. For investors who have corporations and are looking to avoid some of the new passive income rules that came into place a couple of years ago, some of these investments would be treated as active income investments, and so wouldn't sort of hit your passive income limit, which is great. Almost all of them, not all of them, are registered plan eligible. So TFSAs, RSPs, LIRAs. So you can manage your tax by using those accounts and funding those accounts and then making these investments. And there are some more exotic investments that are structured effectively to fit within your tax plan. So again, if you're thinking about tax, if you believe taxes are going to rise, it may be time to think about your tax objective as a key part of your assessment or analysis in your portfolio. And again, I'd strongly encourage you to speak with a private wealth advisor. If you don't feel like you know what the objective of your investments is, it's really good to use a private wealth advisor as a sounding board for that exercise. So one of the things that I like to arm people with is a bit of a checklist in terms of what they should be thinking about when they make these types of investments. The first one, I always start with this, is what's your objective? But then we go through a number of different questions about the investments, but also about you. Because, you know, ultimately what we want to make sure is that you're set up well based on what you're looking to achieve, and also what fits based on your life circumstances. That can be everything from what's your investment time horizon to how old you are, what's your income, what does your family look like, what are you allocating certain budgeting for, you know, are you hoping to buy a second property, are you hoping to fund your kids' education? And then thinking about, well, what's the composition of that? Where do those things fit into the overall plan? But to me, it always starts with the objective. What are we trying to achieve? And a couple of highlights about today's private capital markets. In Canada, these types of investments, not everybody knows this, are effectively available to everyone if there's an offering memorandum. But you do have to meet a suitability requirement. So we're obligated to make sure that, and we being us as a firm and our private wealth advisors, need to make sure that the investments are suitable for you. Offering memorandums are available, and they're also filed on what's called SEDAR. So there's some public disclosure. You can go find those offering memorandums. And of course, as a firm, we have to provide those to you if you're interested in making these types of investments. Dealers are responsible for the due diligence. So we have a team that's responsible for doing due diligence on these investment opportunities. There's annual audited financial statements that are available to investors, also filed on SEDAR. And then they must be sold by a registrant. And it's really important that we know our clients, which is what KYC stands for. We know our products. We've done our due diligence, KYP, and then we match those things in a suitable investment. So I'm going to leave you with a little bit on who is Raintree Financial Solutions and what do we believe in. One of the things over the last 10 years that we've developed is what we call our Core Plus Explore investment philosophy. And we think the traditional model, you know, often it's quoted as the 60-40 model, 60% of your portfolio in stocks, 40% of your model or your portfolio in bonds. We think that that model is a bit broken, particularly if, as we mentioned earlier, you have higher return objectives and that fixed income component isn't going to fit well within your overall portfolio objective. We think there's a better way to do things. We think that the core of your portfolio should be managed by a portfolio manager, and we have a number of available options to our clients by referral, as well as alternative investments rounding out the portfolio. So we think about the portfolio as a bit of a target or concentric circles rather than a pie. And we're really looking to round out that pie using alternative investments, but in the center, having your traditional investments, so your stocks and bonds, managed by a portfolio manager who's got discretionary authority on which investments that you make in that core category of investments in the stocks and bonds space. Raintree Financial Solutions, we've been around since 2010. That's when we originally got registered. We focus on alternative and private investments. We're independent, so we're not owned by a bank. We have offices in Toronto, Edmonton, and Victoria, and private wealth advisors from Ontario to British Columbia. These are financial advisors who would help you make investment decisions. And we're a very technology-focused platform. We've tried to partner with technology companies that are at the forefront of the industry for financial services, because we think that makes our business more efficient and more effective in the way that we can offer our services to our clients, and ultimately allows us to compete with a number of the banks and larger organizations. But it's also a client service. You know, being able to do your transactions electronically, see your reporting electronically. In today's world, under the circumstances, having the ability to do business electronically is critical. And haven't missed a step here through the pandemic in terms of having to operate remotely and make sure that we service our clients. Raintree Financial Solutions is part of a bigger organization. So here we have Raintree Wealth Management, one of our portfolio management options for our clients. Raintree Corporate Finance, which is an investment banking division. That organization helps with the underwriting and due diligence of these investment opportunities, also provides advice to managers and companies about their capital market strategies. And we also conduct mergers and acquisitions activity in that business entity. And then Raintree Insurance Services is a complement to our financial advisors, helping investors, helping Canadians either do risk management inside their portfolio, so thinking about protecting assets, but also estate planning and tax planning using insurance products to effectively do that. We're registered in 6 provinces, so from Quebec all the way to British Columbia, and we've got 47 financial advisors, private wealth advisors as we call them, to help our clients manage their financial affairs and make these types of investments. That's the end of my presentation. I hope it was informative. We do have a Q&A box for those that would like to ask any questions at this time. I'll give just a moment for that to happen. There haven't been any questions throughout, but happy to answer any questions to end this presentation off. But if not, I encourage you to go onto our website. If you don't already have a private wealth advisor, you can see and find private wealth advisors in your local area on our website at raintreefs.com. Or if you're so inclined, I'm happy for you to email me and would love to engage with you, talk more about private investments, alternative investments, our outlook on the market, adding diversification to your portfolio, any of those subjects I'd love to hear from you about. And if I can't answer your question, I'm happy to redirect it to someone who can. Doesn't look like there's any questions. I thank you so much for joining us today, and I hope you found this presentation enjoyable. Have a great rest of your day.